Okay, good morning. Welcome to today's segment. My name is Dr. Justin Irongo, and I'll be taking you through financial institution. And I want us to start off our class by looking at the expected learning outcome for this particular unit. Now, once we go through this unit, by the end of this lesson, you should be, number one, be able to provide a solid definition of financial institution. You should also be in a position to categorize financial institutions, and that you should be able to describe the specialness of financial institutions. So those are the three main objectives that we are going to achieve in our first lesson. Let's proceed. Now, the next one, I would like us to look at the overview of financial institutions. So let us first of all define what financial institutions refer to. So a financial institution are intermediary organization that facilitate the flow of funds between savers and borrowers in an economy. And I'm very sure that all of us here, we have transacted in one way or another with a financial institution, be it bank, be it SACCO, be it fintech, be it microfinance, be it insurance, be it other saving scheme. So, and these are the one that we are referring to as intermediary. They go between the savers and the borrower. If you take money to a bank, you are a saver. If you borrow money from a bank or a financial institution, you are a borrower. Now, this financial institution, they mobilize saving, provide credit, manage risk, offer payment system, and ensure financial stability. So now, remember the concept of mopping up excess liquidity from the economy, from those who have excess, and then giving to those who don't have. That is how the bank manage to balance or to ensure stability in the economy. And I'm very sure maybe in the course of our learning, we have ever come across in macroeconomics the measures that the government use to ensure the stability of money in the economy. So in most cases, they normally use bank. Yeah. So where the government can borrow from bank to ensure that there is no or there is less circulation of cash in the economy, or there is less flow of money in the economy, and this prevents the inflation. Remember, inflation is where in the economy we have too much money chasing too few goods. So the bank can act as a facilitator in this kind of a process. So the government can lend to the government. I mean, the financial institution can lend to the government as a fiscal policy, or they can lend to the public again as a fiscal policy to ensure there is circulation of more money in the economy. Then financial institutions provide services as intermediaries of financial market. So we have said that the banks or financial institutions, they are go between in the financial market. So let us look at the concept of financial intermediation. So financial intermediation is the process by which financial institutions like banks, SACCOs, insurance companies, pension fund act as middlemen between savers, that is lenders of fund, and borrower, that is users of fund. Remember, when you deposit money in a bank or in any financial institution, that financial institution owes you. So you, according for your case, you have an asset, but the institution that you have given money has a liability. Then savers, these are the household, firms, and government who deposit or invest their surplus fund. So if you have surplus fund, be it a household like me and you, firm, these are companies, or the government, they can deposit the money to this financial institution for investment. Then financial institution, they transform these funds into loan, investment, or other financial product. So this financial institution, for example, let's say bank, once they get money from you, then they lend those who don't have, or they can also invest. There are quite a number of investments like fixed income, treasury bills and treasury board, money markets, or other avenues like overseas or overnight lending. Then borrowers, these are individuals, businesses, and government who can access the fund for consumption, investment, or expansion. So borrow again, it can also be a me and you. When we are short of funds, we can still go to the bank and ask for a loan. Or even the government can also ask for a loan, or even for a business. Now let us look at the traditional financial intermediation. So this is the classical system, the one that we know, or the one that our parents used to work on, where people used to go to the bank, the physical bank, and do the transaction. So the risk arising out of the lending is borne by the intermediaries, i.e., there is no financial risk for the savers or suppliers of the fund. So in the traditional financial setup, where we have the bank building, or where we have the physical infrastructure, when the financial institution do give money, it is them who have or who bears the risk of collection. Remember, we normally say that the moment you give out money to anyone, the risk lies with you to collect that money. Yeah. So, and that's when we say that even in our private life, it's a matter of personal finance. Yeah. There are so many banks in Kenya. There are so many circles in Kenya. There are so many companies in Kenya who lend money. Please advise any friend who is borrowing you money, and yet you don't have enough. If you have enough, that's fine. But if you don't have enough, it's good to advise them that they go and collect or get money from the approved financial institution, because those ones, they have the capacity. Otherwise, you are not a financial institution, it's a person. Because the moment you give out the money, most people tend to either to forget, to pretend they forget, or some people, they borrow money with no intention of repayment. So now we have the merits of this traditional financial intermediation. One, it is trusted and highly regulated. So financial institutions, they are highly regulated. For example, the commercial banks, they are normally regulated by the Central Bank of Kenya. And we have seen some banks being closed down, like the case of the Chase Bank. There was another one, I don't know, Metropolitan. I don't remember the actual name, but I know at least there was Chase Bank, which was closed down, and even other banks, they are on the line, and especially those who don't have enough liquidity. We have insurance. They are normally regulated by the Insurance Regulatory Authority. We have SACCOs. They are regulated by SASLA, although we have seen cases of fraud, especially in SACCOs, because of poor corporate governance, including the one which happened with Cusco, and others that most of us, we are aware of. Provide risk pooling and insurance. So because of the economies of scale, they are able to pool insurance, such that in the event there are some risk, this risk, they can't be felt at an individual level. The other one is that they offer maturity transformation. That is, they convert short-term deposit into long-term loan. So those deposits that we normally give the bank, so they collect from various people, me, you, the other person. So those deposits, the bank is able to convert them to long-term loan. So I deposit the money, let's say 100,000 today. And then I will withdraw the same money after 5 days. But now the bank, through the intermediation process, is able now to collect those several ones and give someone a loan of 5 years. Remember, for me, I have just done a short-term deposit. The other person have done a short-term deposit, but those short-term deposit, they compound, and bank is able to convert them into long-term loans. The other one is stable and familiar to users. So most of us, we appreciate the fact that banks are more stable. Yeah, Equity Bank is very stable. Family Bank is more stable. KCB is stable. Cooperative Bank is stable. Insurance, Britam, stable. Microfinance, like Rafiki Microfinance, Fauru Microfinance. We have circles like Stima Circle. They are more stable as maybe compared to what we are going to look in a few minutes, what we call the contemporary financial intermediation. Access to physical support and advisory. So in the traditional financial intermediation, you are able to walk into a bank, the branch that is near you, and you can be offered support or any advisory services as compared to the technological financial intermediation where you just apply loan through the mobile phone. In fact, you don't even know the physical location for those particular financial intermediations. Now, let us look at the demerits of traditional financial intermediation. One, they can be bureaucratic and slow. So you are very much aware that whenever you go to a bank, the processes of processing a loan, they are very cumbersome, very big lines, huge lines, many people have to fill in. I don't know, it's supposed to be signed by credit officer, it's supposed to be signed by credit manager, it's supposed to be signed by risk manager. All these are bureaucracies, which you not see in the contemporary financial intermediation. High transaction cost. So whenever you go to a physical bank or a physical facility, there are quite a number of fees that you are going to get. Maybe stamp duty fee, negotiation fee, bank charges, all that. Limited accessibility. So you find that the banking hour in most cases run from 8 a.m. to 5 p.m. And then you may find that not all the bank or financial institution have branches which are near you. Less inclusive. So these financial institutions, they exclude people in rural areas and those with low income. And finally, on this one, sometimes inflexible with products and services. So the banks or financial institutions, they are not able to customize their product to suit individual needs. And this represents the concept of inflexibility. Now, let us look at the contemporary financial intermediation. So these are the ones which are driven by technology. In the capital market, they do direct finance mechanism to connect savers and borrower, often bypassing the traditional bank. Remember, we have said that the concept of financial intermediation is where we have savers on one side, then we have the financial institution at the middle, and then we have the borrowers on the other side. But the contemporary financial intermediation, these banks are being bypassed. And some of the features of contemporary financial intermediation include one, technology-driven. So where we have the mobile apps, fintechs, and blockchain, greater accessibility. The bank, you can be able to access your bank 24/7. I hear they normally say banki mkononi. The other one is disintermediation. Some savers, lenders invest directly in borrowers via capital market. So you can be able to buy shares direct in the capital market. And when you buy shares direct in the capital market, then that means you have provided capital to the borrowers, but indirectly. Merits of contemporary financial intermediation. One, faster, cheaper, and more efficient transaction. If, for example, you want to take a small credit facility from the mobile app. Some of them, they take less than 48, not even 48 hours. They are instant, like Fuliza, Tara, etc. You can be able to take a loan immediately. Wider accessibility, so you can be able to access your bank 24/7. So wherever you are, whatever the time it is, you can be able to dial in the sort code which is normally provided and able to access your bank and able to access your money. Promote financial inclusion. So these are contemporary financial intermediation because of accessibility of the mobile phone. Those who are unbanked, they are able to get the services. For example, I remember the groundbreaking M-Pesa and M-Shwari. So these products, they facilitate financial inclusion. There are quite a number of people who don't have banks in Kenya or they don't have bank account. But because of this revolution in the financial market, these people are able to access banking product through this financial intermediation. Offer innovative product, that is P2P lending, crowdfunding, and the crypto. So these are online lending. You find that the way they do lending, that is, they get they lend money, then they collect, and some of them, they normally use currencies like cryptocurrencies. Those are the digital currencies. Lower transactional cost compared to bank. So you find that the cost for online lending, although this can be debatable because some of them are extremely very expensive, and especially when you are borrowing. But when you are withdrawing, you find that the cost sometimes is relatively lower. Now, this contemporary financial intermediation, they also have some risk or some demerits. One, less regulated, in many cases, higher risk. So these are contemporary, they are not regulated, although currently the Central Bank of Kenya is making effort to have all the fintech being regulated, and I think the process is almost complete. So this one will be overtaken by event. But the fact is that when they are not regulated, it means they can be an avenue for fraud. Then we have the cybersecurity threats and fraud. So in most cases, this contemporary financial intermediation, they lose out of money, and especially from fraud cases. The other day we had a gentleman from Melu who was able to withdraw 11 million, I think, from a betting company, and this is a case of cyber threat and fraud risk. They can be volatile. The cryptocurrency and fintech startups, reliance on technology, digital divide. That means that they cannot work without technology. You can imagine somebody in a remote area like in Mandera or Wajir or any other remote area in Kenya where there is no even internet access. So this means it is promoting digital divide. Many lack personal advisory or human interaction. So you are only interacting with your gadget. So there is no one who is to advise you maybe on the product, suitability, the amount that you can take. So that lack of personal advisory or human interaction is a limitation as compared to the traditional financial intermediation. So now let us compare the two. So we are going to use the aspect, for example, the main players. In traditional intermediation, the main players are banks, SACCOs, insurance, and pension. In modern intermediation, we have fintechs, P2P platforms, and capital markets. The mode, traditional intermediation, it is indirect, that is bank as a middleman. Modern intermediation, we have direct plus indirect. The indirect, these are the tech enables bypassing the banks. Then we have the technology use. We have low branch-based paperwork. Then we have high app and mobile blockchain. Then we have accessibility for traditional intermediation. These are limited the banking hours, but for modern intermediation, it is global and it is 24/7. Examples of traditional intermediation, especially in Kenya, we have Equity Bank, Cooperative Bank, or Mutual. Then modern intermediation, we have M-Pesa, PayPal, Robinhood. I think Robinhood is not yet in Kenya, and Binance is not yet in Kenya. Now, so far so good. Let us now look at the classification of financial institution. So financial institution can be classified into 4 major groups. So we are going to start with the first one by the function. So by the function, we look at the depository institution, and this depository institution, they accept deposit and provide loan. Examples, we have the commercial banks, saving and credit cooperative circles, we have microfinance institutions. So this institution, they accept the deposit from depositors or savers and provide loans to the borrowers. Then we have non-depository institutions, and this one do not accept the deposit but provide financial services. Example, you have insurance company, pension funds, investment banks, and financial companies. So non-deposit, they don't take deposit, they do not accept the deposit, but they provide insurance, they provide financial services. For example, if you look at the insurance companies, you buy insurance products, pension fund, they normally provide the pension services. Investment bank, they normally provide the investment advisory services, and other financial companies. Then we have regulatory and supervisory institutions, and the work of this one is to oversee, to regulate, and stabilize the financial system. An example, you have the central bank, which regulates the central bank regulates the commercial banks and MFIs. Capital Market Authority regulate other financial institutions like the money market funds and the public listed companies, Deposit Insurance Corporation, and this regulate the insurance markets. Then the second classification is by ownership. So by ownership, we have public versus or government-owned institution. So these are, for example, you have the Central Bank of Kenya and Kenya Development Corporation. So these one are solely owned by the government. Then we have private institutions. So these are owned by individuals or shareholders. We have Equity Bank, Britam, and Old Mutual. Just examples. Then you have cooperatives and or mutual institutions. These are SACCOs or the Cooperative Bank of Kenya. They are owned by the mutuality principle. Then we have by area of operation. So we have those which operate locally, and we know them, the Equity Bank, National Bank, etc. Then we have the international or multinational financial institutions, and this operates across different countries. We have IMF, World Bank, and African Development Bank as examples. Then we have by nature of service, commercial banking institutions. These accept deposit, provide credit facilities, facilitate payments. Example, we have KCB and Standard Bank. Then we have investment institutions, and these facilitate investments in securities in capital market. Example, we have NSE and stock brokerage firms. Then we have development financial institutions, and these provide long-term project financing. Example, we have Kenya Development Bank, Industrial and Commercial Development Bank, etc. Then, continuing with the nature of service, we have insurance and pension institutions, and these provide risk management and retirement benefits. Example, we have Jubilee and SSF. Then we have microfinance institution, and this they provide small loans and financial services to low income groups. Example, we have Fauru and Kenya Women Trust Fund. Then we have the Credit Reference Bureau. And Credit Reference Bureau, their work is to collect credit information from all financial institutions, and they amalgamate or they condense this information into one report. And in this way, they help to analyze credit report before it happened. For example, if you have borrowed from Bank A, Bank B, Bank C, Sacco A, Sacco B, Freezer A, Freezer B, so and then you have defaulted. So all this information is collected. So when you go to borrow in another financial institution, they'll tell you, your credit score are not good because you are a serial defaulter. You have not paid from X, Y, and Z. Then let us look at the concept of specialness of financial institutions. Why are the financial institutions regarded as special institutions? So financial institutions are special because they perform functions that are or that no other institution can perform as effectively. Their uniqueness arises from their role in mobilizing saving, allocating resources, managing risk, and stabilizing economy. The general area of financial specialness include: one, we have information asymmetry. So information asymmetry is whereby um, we need to have the same information. So the financial institution, they help to reduce information asymmetry because they are able to collect information from borrowers and screen that information before they give loans. Then the other one is maturity transformation. That is the ability to convert short-term liabilities, that is the deposit that we normally give, that can be withdrawn actually anytime, into long-term assets. So these long-term assets are mortgages and business loans. Then we have risk transformation. So by pooling deposit and investment, institutions spread and manage risk. The other one is liquidity provision. So savers can easily access their money while borrowers still use funds for long-term projects. Payment and settlement services. So financial institutions provide safe, reliable, and efficient payment system. So you can use maybe the ATM, visas, and other platform to pay for services and even goods. Economies of scale, they can provide financial services at lower cost because of specialization and technology. Monetary and economic stability. So through the link with central bank and regulations, financial institutions play a role in implementing monetary policy and stabilizing economies. We continue. Let us look at the functions of financial institutions and intermediaries. So you realize that the functions of financial institutions and intermediaries, they are more or less the same. They are more or less the same as why financial intermediaries are special. The first one is mobilization of saving. That is, they collect surplus funds from households, businesses, and government. Two, the allocation of capital. That is, they get money from those who save to those who want to borrow. Risk management. So they provide a mechanism for managing financial risk through insurance, diversification, and hedging. Maturity transformation. We have talked about that is converting short-term funds to long-term. Liquidity provision allow depositors and investors to convert their asset into cash easily. Payment settlement, that is, they facilitate transfer of money. Monitoring and information services, that means they're able to reduce information asymmetry by screening borrowers, rating creditworthiness, and monitoring investment. So those are, then we have implementation of monetary policy. So we talked about the central bank using the fiscal policies to regulate the supply of money in the economy. Either they can have an objection or an objective of increasing supply of money in the economy or reducing the money in the economy. Promotion of economic growth and stability. So by channeling funds, creating investment opportunities, and supporting trade, financial institutions contribute to national development. Remember, they also pay taxes, and in fact, currently financial institutions, they are doing the best, and therefore they pay higher taxes, which helps to promote the economic growth. So that marks the end of our first lesson and topic 1. So now, these are the sample examination questions which you can use for revision. And you are not going to expect anything different, even from the exam, from this particular question. So please pay attention to this question. And in the event that you have any clarification that you want to make, I am much available so that you can engage further. Thank you all and have a good day.